Fact or fiction, IPOs are always profitable. Welcome back to The Motivated Investor. Today, we're diving into a hot topic that has stirred up a lot of conversations in the investing community. We're asking the question, are IPOs always profitable? This is a critical topic for anyone looking to invest in new companies, so let's unpack the truth behind initial public offerings. First, let's start by understanding what an IPO is. An initial public offering is when a private company offers its shares to the public for the first time. This can be an exciting time for a company, as it opens the door to a vast pool of capital that can be used for growth and expansion. But the real question is, do these IPOs guarantee profits for investors? To answer that, we need to look at historical data and trends. Many people believe that investing in IPOs is a sure way to make a profit. After all, some of the most well-known companies like Facebook and Google saw their stock prices soar shortly after going public. But here's where the narrative gets tricky. Not every IPO turns out to be a golden ticket. For instance, some companies experience a surge in their stock price right after the IPO, only to see it plummet in the months that follow. Take companies like Snap Inc. or Blue Apron as examples. They had highly anticipated IPOs, but their stock prices faced significant declines shortly after debuting on the market. This highlights that initial excitement can sometimes cloud the reality of a company's long-term performance. So, what makes an IPO successful or a failure? Several factors come into play. The overall market conditions, the company's financial health, and even investor sentiment can dramatically impact the success of an IPO. It's crucial for investors to do their homework and analyze the fundamentals of a company before jumping in. Another important aspect to consider is the lockup period. After an IPO, there's typically a lockup period during which insiders cannot sell their shares. Once this period ends, a flood of shares can hit the market, potentially driving down the stock price. This is something many new investors may overlook. Moreover, not every IPO is created equal. Some companies go public with strong fundamentals and a solid business model, while others might be riding on hype without a sustainable plan. It's vital to differentiate between a solid investment and a speculative one. In addition, the role of underwriters cannot be ignored. They often set the initial price of the shares based on their own research and market conditions. Sometimes, underwriters may price shares too high, which can lead to disappointing performance once the stock begins trading publicly. So are IPOs always profitable? The answer is a resounding no. While some IPOs can lead to significant gains, many can also result in losses. As an investor, it's essential to approach IPOs with caution and a well-informed strategy. To sum it up, the allure of quick profits in IPOs can be tempting, but the reality is far more complex. Do your due diligence, understand the company you're investing in, and remember that investing always comes with risks. Thank you for tuning in to The Motivated Investor. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more insightful content on investing and finance. We appreciate your support, and we'll see you in the next video.